Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host Neena Mishra. My guest today is Chris Humer, Senior Investment Strategist for FlexShares ETFs at Northern Trust. Northern Trust offers 32 ETFs in the US with over $21.6 billion in assets under management. We are talking about the current market environment and why investors should focus on quality, value, dividend, and low volatility in the current market environment. And we'll also discuss some inflation protection strategies. Chris, welcome. Great to have you on the show.
Neena, it's a pleasure to be here. Thanks for having me.
So I like to start with the recent market action because there's so much happening every day in the market. We continue to see these violent swings, and for reference, we are recording on Wednesday, May 18th, and stocks are under heavy selling pressure today after major retailers like Target and Walmart said that rising costs and slowing sales were going to affect their profits. So tell us about your thoughts on the current market environment. And do you think this selling will continue in the coming days, coming weeks, or do you think we are close to bottoming out?
Yeah, Neena, I think there's a lot that continues to go on, and there's a lot of uncertainty. I think it boils down to really three questions that investors have. Obviously, there's a lot more than these three, but I think it boils down to questions around inflation, interest rates, and growth. How long is inflation going to stay elevated? How will the Fed continue to shift monetary policy to combat inflation? And how successful will they be in battling inflation? And then obviously, at the end of the day, what will be the impact on growth? And I think that's what we're seeing today is kind of a double barrel approach to what the news this morning of margins coming under pressure, both with the Walmart reporting yesterday and Target today, is that the growth is under question, and with inflation being high, we're seeing that really come under pressure in the retail space, and that's obviously what it has been selling off big time today. So I think all of that kind of comes into play, and there's still a lot of questions on that. And then if you add in the comments that Chairman Powell made yesterday, that strengthening the resolve that the Fed is going to look to get inflation under control, that really gives a little bit of a clear view on the monetary policy side of it, that they're going to continue to tighten. Now, the question is, how successful will they be, and where will inflation go from here? I think there's a view in the market that we are at or close to at peak inflation, or at least that's the optimistic approach. But the key is really where we end the year at. So if inflation does come down, if CPI does come down from where we are today, where is that going to be? I think the view is that going from 8% to 5% will be a normal roll off, but it's going to be much harder to go from 5 to 2%, which is the Fed's target. So where do we end up at the end of the year, and what will the Fed need to do to adjust expectations to drive that? And what is under the Fed's control and what is not? So there's a lot of uncertainty in the market, and then really it's going to be how effective the Fed is at managing inflation, and what does that do in terms of growth? And I think we're seeing that in the reaction in the market today.
Right. I agree with you that there's a lot of uncertainty for investors, and it all depends on how successful the Fed will be and where the inflation is going to be in a few months from now. So FlexShares recommends that investors should focus on value, quality, dividends, and low volatility in the current market environment. And you have some ETFs that focus on those factors. So we'll talk about those ETFs in a little bit. But first, tell us why these factors tend to outperform in these kind of uncertain market environments.
Absolutely. And I think there's a couple of different drivers here that have made these factors attractive in the current market environment. Let's start with value and dividend yield, because really dividend yield and value tend to be usually correlated to one another. Dividend yield could be looked at as a way of evaluating value. And really, we're seeing the relationship between value and growth stocks and interest rates come into play. And this has been historically shown, and it's continuing today, in that, really, when we look at value and growth stocks, there's a view that you could almost look at them as short and long duration equities, similar to look at short and long duration fixed income, in that growth stocks, because those cash flows that you are, as a common equity holder, are looking towards as the value of the company, are so far off in the distance. It's almost like a long duration bond, in that it's highly sensitive to interest rates. And the reason for that is, if you think about the discounted cash flow model, the time value of money, if you're raising that discount rate and rates are going higher, that really impedes the current valuation of those future cash flows. And the further off they are, the more that's impacted. So as rates go up, we tend to see growth companies historically have been more affected than value companies. And if you think about where we were at the beginning of this year to where we are today, we've had a dramatic shift in interest rates as we talk about the Fed and inflation. We've gone from, at the end of the year, the market expectation was somewhere between 2 or 3 rate hikes for all of 2022. And where we sit here today, we've already had 3 rate hikes through the May meeting, and the market expectation is for 8 more 25 basis point moves, some of them being 50 basis point moves, but 8 more quarter basis point hikes by the end of the year. So you're talking about 10 to 11 hikes for this year when the expectation was 2. And that has really had a dramatic effect on growth companies, especially in line with value. So when it comes to value and growth, we find value effective in this rising rate environment, and that's aligns with the historical view of value and growth over time. From a low volatility standpoint, this really has more, in my mind, to do with the relationship between stocks and bonds in deflationary and inflationary environments. In deflationary environments, really what we have been in since the middle to late 90s until last year was, in deflationary environments, prices of bonds and prices of stocks are negatively correlated, meaning that as interest rates rise, so as the Fed pushes interest rates higher, actually stocks tend to move higher as well. So negatively correlated with bond prices. Remember, yields go up as bond prices go down. So if yields are going up, stock prices going up in a deflationary environment. The reason for this is the view is that the Fed is raising rates to combat the overheating growth. And with growth being strong, they feel that they are able to raise rates. And that's what we've seen over the last several cycles. However, that's very different when you look at an inflationary environment. In an inflationary environment, stocks and bonds are positively correlating, meaning that the Fed is raising rates, bond prices are falling, and stock prices also fall. And the reason for that is the Fed is not raising rates to combat high growth or overheating growth. They're raising rates because of high inflation. And that's the environment we've been in now. It's also, when you look back at the 70s and 80s, you could see that stock and bonds are highly correlated to one another. The reason why this matters is if you think about the 60-40 portfolio, the reason why that traditional portfolio of 60% equity, 40% bonds exists is to get that natural diversification in these deflationary environments. So when it's a deflationary environment, you have nice diversification between stocks and bonds because of that natural negative correlation between stock prices and bond prices. However, in inflationary environments, that correlation breaks down and actually reverses. And so with a positive correlation, you don't get that benefit. And you're seeing that today. And so where this all comes from a low volatility standpoint, is as we talk to our institutional investors and our retail investors about where they should be moving their money, and they talk about where they want to position their portfolios. Moving to bonds is not going to offset is not going to give the diversification benefits from stocks. And so really where low volatility comes in is twofold. One, it allows them to take some volatility off the table, de-risk their portfolio theoretically by moving to lower volatility names. So while you're not moving to fixed income, you're moving to lower vol names through a low volatility strategy, and also to participate in equity market upside while still protecting on that downside. So really that is what we see from a low volatility standpoint. And then from quality, really what we find is in periods like this, fundamentals matter. And so when we talk about the quality of the company, we're really focused on really financial statement metrics, things around profitability, management efficiency. And when I say management efficiency, what I mean is how aggressive or conservative is a company in their deployment of capital, both in external financing decisions as well as in managing capital expenditures, and then cash flow. And I think what we've seen in many crises is that quality tends to do well because these levers separate those companies that are best positioned. So those companies that have higher profit margins tend to do better. Those companies that are more conservative with their management of their financings do better, and those companies with extra cash flow on hand all do better. And so really that's what we try to distill with the quality score. And again, that's something that we feel does well in this type of environment.
All great points. Now let's take a look at some of the ETFs that FlexShares offers. These ETFs focus on these factors. So I saw you have the Quality Dividend Index Fund, ticker symbol is QDF. There's an ETF focusing on quality and low volatility. The ticker symbol is QLV. And there's an ETF which focuses on quality large cap companies. The ticker symbol is QLC. Tell us more about these ETFs.
Yeah, Nina, I think what we do at FlexShares is fairly different. I think if compared to a lot of ETF providers out there. A lot of ETF providers start with combining specific factors together and applying that across all product types. And there's nothing wrong with that. You know, you're focusing on these factors that historically have been compensated risk factors, and that you're targeting those in a specific combination. I think what FlexShares has aimed to do is turn that on its head a little bit, in that we're looking to design ETFs to meet specific objectives, and our factor combinations vary because of the different goals that our clients have. So for example, those that are focused specifically on generating income in their portfolios, products like QDF that you mentioned, we actually offer 3 flavors of QDF. The base product QDF that you mentioned, there's also a product that has a slightly lower beta, and a product that has a slightly higher beta. That's QDEF and QDYN. That suite of products are all focused on quality and yield, so really on generating income for a client's portfolio. When it comes to capital appreciation, really it's different factor combinations based on that client's goal. So you mentioned quality, low volatility. Obviously, we talked about how investors are looking at low volatility. The reason we like quality and low volatility in combination is that we find the poorest quality companies often tends to be those that are the most highly volatile. And so what we're looking to do is target high quality companies that also then use a mean variance optimization to get the best portfolio and get the best lowest volatility on a portfolio level. But then you mentioned QLC, and the other product I would talk about would be Tilt. You know, these are different factor combinations depending on what clients want to do. QLC is the quality large cap product, is quality, value, and momentum. So again, different factor combination that is designed to give access in the large cap space to those companies that really are driving these 3 compensated risk factors together. And then on the other side, Tilt is really more of a total market product that is looking at combining size and value. Size, a factor we haven't talked about. Generally, from a factor combination standpoint, two factors that diversify well with one another, size and value. Obviously, we talk about value right now being fairly attractive. Size has struggled a little bit this year, but that's why we have that combination in that product to give total market exposure that has these factor combinations together. I think the other thing that we are always talking to clients about is focusing on the factors or the risks that you are compensated for and trying to mitigate those that you are not. And so things like sector specific, security specific, style specific bets within these factors and these factor products, we're trying to control for as best as possible. So we're controlling for sector exposures. These are all US market focused products. We have companion products for all of these that cover developed markets and emerging markets. Those also control for country and regional sector exposures as well. So you're controlling for those things that on a general factor basis you're not compensated for, while still being able to get that factor exposure, which I think is really attractive to clients.
All very interesting products. Now let's talk about inflation. And you mentioned inflation as one of the biggest concerns for investors this year. Inflation is now running at its highest levels in 4 decades. And unless there is some resolution to the war and the supply chain disruptions which are caused by China's zero COVID policy, unless there's resolution to that, inflation may continue to run high. And you alluded to Fed Chair Powell's remarks yesterday, and I think those remarks were his most hawkish remarks till now. And he said that the Fed will continue to raise rates till there is clear evidence that inflation has started coming down. So tell us how investors should prepare for inflation.
The way that we look at inflation is that there's no one tool that is able to protect against inflation. There's no one silver bullet. The way that we talk to our clients about managing inflation expectations is really with a multi-time horizon approach. So we look at it across short-term, intermediate term, and long-term. On the short-term side, that's where instruments such as TIPS are the most effective. This is really for more unexpected inflation. So we talk about what is the market expectations around inflation and how we're at these highest levels. If the expectation, if you look at break-even spreads, is that we will come down from this high elevated level, and then the question is how low do we come by the end of the year? But if that number stays elevated longer, that would be unexpected inflation. That's where TIPS securities would be attractive as part of a portfolio. That's on the short end. On the intermediate side, we like natural resource equities or commodity futures. Those tend to do well in that 5 to 15 year time horizon from an inflation protection side. The reason why TIPS are kind of ineffective when you get to a little bit further out in time horizon is because TIPS are treasury securities that pay interest. What you find to see is that the correlations to CPI tend to degrade, and that the interest rate component of those securities overwhelms the inflation protection component over a longer time horizon. And then really on the long end, you're looking at things like infrastructure or real estate or common equity markets as the ways to control for inflation over the long time horizon.
So you mentioned natural resources, and you have an ETF which focuses on global companies that operate or manage or produce natural resources. That is in energy, agriculture, metals, timber, water, etc. The ticker symbol is GUNR. This is the FlexShares Morningstar Global Upstream Natural Resources Index Fund. And this is in fact, your biggest ETF and also your best performing ETF year to date. Tell us more about this ETF.
Yeah, and it's no surprise that it's the best performing year to date when you look at markets, because the only sector that is positive, I believe, utilities was positive as yesterday, but with the solve today, I'm assuming that energy is really the only sector that's positive. And so really we've seen natural resources, really, if you look at the commodities complex, the only commodity that is not positive year to date is cattle. Everything else is very positive for the year. If you were to look at, energy prices year to date, you're talking about WTI is up, 45% for the year. And whether you're looking at Brent or gasoline, heating oil, natural gas, all of those are positive. And that, when you look at the complex of commodities, they're all positive. And so natural resource equities is similar to that, that they're all positive, or that they're in the positive territory as well. So from a performance standpoint, that's why, I think they're good. The reason why we feel that natural resource equities is a better investment vehicle over the long term is that when you look at commodities futures, it's important to realize that the returns from commodity futures is really three components: the spot price, the carry yield, and the roll yield. Now, the spot price is really what we talk about when we talk about, okay, these commodities are doing well this year. But what happens is, because you're talking about futures contracts, you have to roll those over from period to period. And as you roll those over, you tend to be in a position where future commodities costs are higher than current commodity costs. That means that the commodities curve is in what's known as contango, which is the normal state that you find commodities curves in. So whenever you are rolling from one contract to another, you are eating up some of that return. There are periods where the curve is in backwardation, where it works out in your favor when you're rolling it. But generally speaking, more often than not, the curve is in contango. Additional to that is you don't have access to certain areas of the commodity complex in futures, because there's not many futures contracts on that. So when I think about like areas such as timberland and water, there are some timber contracts out there, but they're not there's not as much depth there as the traditional commodities. And water, there's virtually no commodities contracts on. The reason for that is why we like timber and water. Timber for us, or timber historically has had the highest correlation of all commodities to CPI or inflation. And the reason for that is, if you think about the difference between timberland and any other commodity, is if you delay harvesting, that commodity actually grows. You don't have the same with a gold mine. If you don't extract the metal out of the ground, it doesn't grow necessarily. Where from a timberland perspective, there's actually real growth if you don't harvest it that year and you let it grow another year or so. And because of that, it tends to have high correlations to inflation. Water for us is a key component of all commodities, whether you're talking about energy, metals, obviously agriculture, but even timberland. Across the whole commodity complex, you find that water is a key component. So it was a key component that we wanted to include into GUNR, the natural resource product that you're talking about. And the other key thing that we want to do is focus on the upstream nature of these areas. That's when you look at natural resource equity, the key is going to be to focus on the upstream portion of the supply chain. Those companies that are actually doing the exploration and the extraction of those of energy, metals, agriculture, and growing that. And so by focusing on upstream, and that's what we found in an index provider like Morningstar, they were able to harness that in the design of the index that we were able to leverage for the ETF.
Excellent. Now, you also say that infrastructure can also serve as an inflation hedge, but you take a slightly broader definition of infrastructure, and you have an ETF which focuses on infrastructure. The ticker symbol is NFRA. So tell us more about infrastructure as an inflation hedge and more about this ETF too.
So when we talk about infrastructure, you're talking about location-specific, mission-critical, midstream companies that really revolve around the transportation of natural resources, people, information from one location to another. They tend to be unique in that they have large barriers of entry. They tend to have inelastic demand, meaning that whether we are in a booming economy or in a recession, they tend to be needed by individuals. Everybody needs access to water and waste management and information, as well as being able to go to work. And so transportation, is a key component of infrastructure. And they tend to be, because of the high barriers to entry, tend to be fairly monopolistic in how they operate. You don't have multiple power lines coming to your house. You have one singular electrical power company coming to your house. And because of that, they're highly regulated. So when it comes to an inflation standpoint, reason why we think infrastructure, and why it empirically has been shown that infrastructure is a good long-term inflation hedge, is for a couple reasons. One, because of the inelastic demand, they tend to be resilient to changes in the market cycle. Additionally, because they're highly regulated, oftentimes increases in prices are directly tied to CPI. So what happens is government entities regulate how much an electrical company can charge for their services, with the caveat of increases typically have to be tied to CPI. So in years where CPI is higher, they're able to mitigate their costs pretty well by managing that input, as well as they also tend to have low operating costs once they're an existing structure, as well as when there's high inflation, replacement costs of these long-term, long-duration assets, it becomes much, much more costly to do, making existing infrastructure projects more valuable. So overall, it's a really good long-term inflation hedge. They tend to be very brownfield companies, meaning they're large existing entities. So they often have very predictable revenue streams and predictable costs. So from that perspective, they also tend to, generally speaking, throw off some dividend income. So that's all the positives. The one thing to be aware of that we're always conscious of when we talk about infrastructure is that because of the unique nature of these businesses, they also come with unique risks. One of them being that they're not businesses that can shift where they're located very well. So when you're talking about a power plant, if there's a change in the regulation of that company, you can't take that power plant and move it to a new favorable tax regime. So you're kind of stuck in those locations. You also see in sometimes where because they're so capital intensive in nature, when there's impairment from things like natural disasters, you from a location specific nature, can't move it, and you're stuck in those situations. So the way that we combat that is by looking to take broad diversification across the infrastructure complex, and moving to areas of like communications and government outsourcing, in addition to things like transportation, utilities, and energy companies, really gives us a broad diversification through a global picture. And I think that's one of the things that I've been talking to a lot of clients about this year is don't be fooled by some of the domestic energy heavy utility strategies that are out there that are tied closely to energy utilities and pipelines, which have had a very strong year, but overall don't give the diversification of the asset class of infrastructure. And if you're looking to buy infrastructure for strategic holding, we recommend taking a broader, more diversified approach than focusing on a very energy-centric approach to the space.
Great. Now, I also wanted to talk a little bit about fixed income portfolios. And we know that this year is very challenging for fixed income investors as well. In fact, both stocks and bonds, they are declining this year at a pace which has not been seen in decades. And we know that bond prices decline, bond values decline as interest rates rise. So how can fixed income investors or investors, how can they position their fixed income holdings for the rising rate environment?
Yeah, Nina, I think duration positioning is really key right now. Northern Trust, from our own asset allocations, our preference is to take credit risk over term risk, particularly in the U.S. And you see that in our asset allocations. Actually, our largest overweight today is in the high yield asset class. So when you look at our strategic asset allocations, that's our largest overweight, which for many people would kind of be a moment of pause. We view high yield differently than most, in that we view it as a risk asset, not a risk control asset. So we group it with things like equities or real assets or alternatives in our risk asset category. So essentially, it is the safest of the risk assets, as opposed to, for lack of a better term, the riskiest of the risk control assets. So with that in mind, we're overweight high yield. I think when we look at the high yield space, it's already priced in some of the economic slowdown, and priced in there is some uptick in default rates. But overall, we feel that it's an attractive place today, particularly when offsetting the term risk, which is one of the other key things that we're looking to monitor here. Outside of high yield, I think attractive areas are active fixed income in the lower duration space. One of the products we have are Ready Access Variable Income product. Ravi is an active fixed income product that has a duration less than 1, that invests in investment grade securities that have low duration. So, there's the potential to earn greater yields than T-bills and take more of your risk budget in fixed income to the credit risk with a product like that than on the duration side. And then the third area that I think we're seeing more and more interest in is mortgages. Again, if you think about the agency-backed MBS securities out there, you're talking about high-quality securities, generally having better yield than treasuries, and with rates going up, prepayment risk coming down, as the people who refinance at lower levels are not going to refinance again as rates go up. I think in the mortgage space, the thing to be aware of is again duration, and being able to be conscious of your duration exposure in your mortgage-backed security strategy. So our product in the space, MBSD is the ticker, looks to manage duration to a certain extent. It's a little difficult in the MBS space, but that's a product that can be attractive for people who are looking at the MBS space today.
Great stuff. That's all we have time for today. Chris, thank you again for joining us.
Nina, it was a pleasure to be here. Thanks for having me.
Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. And also make sure to subscribe so that you do not miss any episodes. If you have any comments, questions, or suggestions, please email podcast@stoxx.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.